gentlemen, good day and welcome to the Anupam Rasayan Q1 FY2024 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Advait Bhadikar from EY. Thank you, and over to you, sir.
Thank you, Lizanne, and good afternoon, everyone. Welcome to Anupam Rasayan India Limited Q1 FY24 earnings conference call. Please note that a copy of our disclosure is available on the investor section of our website as well as on the stock exchange. Please do note that anything said on this call which reflects the outlook towards the future or which could be construed as a forward-looking statement must be reviewed in conjunction with the risks that the company faces. This conference call is being recorded and the transcript along with the audio of the same will be made available on the website of the company and exchanges. Please also note that the audio of the conference call is the copyright material of Anupam Rasayan India and cannot be copied, rebroadcasted or attributed in press or media without specific and written consent of the company. Today from the management side, we have with us Dr. Kiran Patel, Chairman, Mr. Anand Desai, Managing Director, Mr. Amit Khurana, Chief Financial Officer, and Mr. Vishal Thakkar, Deputy Chief Financial Officer. I would now like to hand over the call to Dr. Kiran Patel for his opening remarks. Thank you, and over to you, sir.
Thank you, Advait. Good evening and welcome everyone to the Q1 FY24 earnings call. As we enter the new financial year, part of the global economy continues to face headwinds. While we saw some green shoots in select economies with emphasis on de-risking based on certain geographies, overall, the global situation still remains uncertain. In the agrochemical sector, global demand remains subdued with higher channel inventory coupled with China coming on stream, which is leading to demand-supply mismatch. This trend is evident in the downward revisions in the guidance by various global agrochem companies. Turning our attention to Anupam Rasayan, Q1 24 performance, our consolidated revenues reached around 398 crores, showcasing a strong growth of 19% year-over-year. Our contract-based business model has shielded us from the deflationary pressure in the market, ensuring stable profit margins. As a leading innovation on most of their niche products and have minimal exposure to commodity products, and this protects us from price fluctuations in the commodity chemicals. Anand will highlight business performances in his opening remarks. We are strengthening our focus on pharma molecules, and therefore we have earmarked on technical collaboration with 3Xpert Innoventure Limited. I am confident that this collaboration will help us build a strong pipeline of new age pharma molecules which focus on continuous chemistry. This will be a natural extension of our current business model as well as our strategy of remaining always ahead of the curve when it comes to process engineering. I would also like to update you all on some of our ESG initiatives which are very important to us. I had informed in one of our previous calls that we are systematically transitioning to clean energy, and we have achieved a milestone in this regard. In addition to our solar installation of 17.9 megawatts, we are working on multiple initiatives to reduce our environmental footprint. I would like Amit to address the same in his opening remarks. On that note, I will hand over the call to Anand for his opening remarks. Thank you once again for joining us over the call. Over to you, Anand.
Thank you, Dr. Patel. Hello and good evening, everyone. Welcome to our Q1 FY24 earnings call. I'm happy to update you on our business performance for this quarter. Our consolidated revenue grew by 19% YOY to rupees 398 crores. The growth for the quarter was driven by the strong performance of Tencent Industries, whereas we have been able to maintain standalone revenue similar level on a YOY basis as growth in the demand shifting to later half of the year. I would like to highlight that our order book continues to remain strong and has been a strong growth in this quarter. Despite the discretionary environment, we were able to maintain our EBITDA margins in our long-term margin band at 29% for the quarter, largely due to our business model. Moving on to the business update. As of 30th June 2023, we have signed LOIs and contracts worth 7,669 crores, giving us a strong revenue visibility for the coming years. During the quarter, we signed LOIs worth 4,066 crores, solidifying our growth and revenue visibility. Out of this 4,066 crores, we have signed contracts with two renowned Japanese multinationals for 3,686 crores. We have also signed an LOI with an American multinational for high-value fluorinated products. This is a major step in expanding our geographic presence in the U.S., and we expect our revenue share from the U.S. to increase significantly in the coming years. Overall, these LOIs reinforce the increasing confidence of global MNCs in our technical capabilities and brand value as a trusted partner for developing and manufacturing high-end customized molecules. The new business development team in Japan, USA, and Europe have been instrumental in providing us with enhanced access to key strategic customers, leading to niche high-end molecules, and have also shortened business development cycle time in these geographies. On the product side, in FY24, we have a pipeline of 10 plus new molecules to be commercialized, and we have already launched 2 new fluorinated pharma molecules in Q1 FY24, taking the total number of products to 55. We are also at a final stage to commercialize a new age molecule using flow chemistry. Anupam will be the first company globally to launch this molecule using flow chemistry. This will be a harbinger for development of many such niche products using industry-leading technology. On a concluding note, while the external environment remains volatile, our order book remains strong, thereby giving us confidence of delivering robust growth in FY24 while maintaining margins at current levels. I would like to hand over the floor to our CFO. Over to you, Amit Bhai.
Thank you, Anand sir. Good evening, everyone. I will discuss some important financial updates before handing over to Vishal Bhai for his remarks. Let me begin with an update on the CAPEX. Out of the planned CAPEX of around 670 crores, rupees 124.4 crore CAPEX was spent till end of Q1 FY24, and balance of the CAPEX would be invested in next 12 months. These plans will be majorly used to cater to the demands from the signed LOIs and contracts worth rupees 7,669 crores. These plants would be multi-purpose manufacturing facilities similar to our existing facilities. I reiterate that we expect higher asset turnover and incremental ROCE from this CAPEX. On ESG initiatives, as Dr. Patel mentioned, we have been able to save around 12 crores per year on account of installation of 17.9 megawatt solar power plant. Along with solar, In another initiatives, we are at signing stage for an MOU to lease 150 acres land in Surat and Bharuch district for tree plantation. Test carbon sink and reduce carbon footprint. We will plant over 1.66 lakh trees on this land. We are happy to share that in this quarter, we have achieved a significant milestone by successfully conducting a trial of using biomass instead of coal to generate steam at one of our Jhagadia plants. This would significantly reduce our dependence on fossil fuels. With this, I hand over the floor to our Deputy CFO, Vishal Bhai, who will take you through the financials in detail.
Thank you, everyone. Thank you, Amit Bhai. Hello and good evening to everyone. Thank you for joining us here today. I would like to briefly touch upon the key performance highlights for the quarter and the year ended 30th June 2023. And then we will open the floor for question and answer. Before I proceed, I hope you all have had a chance to go through the detailed presentation submitted to the exchange and uploaded on our website. Kindly note that our numbers for the quarter are on the consolidated basis, and they also include 10-pack numbers. Financial highlights for the quarter ended June 30, 2023 are: total revenue for Q1 FY24 was at 3,988 million rupees as compared to 3,343 million rupees in Q1 FY23, up 19% YOY. EBITDA, including other income, was at 1,138 million rupees in Q1 FY24 as compared to 892 million rupees in Q1 FY23, growth of 28% YOY. This would translate into an EBITDA margin of 29% in this quarter. Profit after tax was at rupees 528 million in Q1 FY24 as compared to rupees 420 million in Q1 FY23, a growth of 25% YOY before minority adjustment for the minority interest. Moving on to the segment-wise performance for Q1 FY24, our life sciences segment contributed around rupees 255 crores compared to rupees 290 crores in Q1 FY23, while other specialty contributed around rupees 28 crores compared to 14 crores in Q1 FY23. In percentage terms, the life sciences segment contributed 90% of the total revenue, and the balance came from the other specialty chemicals. Exports for the quarter was around 61% and continues to be a major contributor to the revenue. Our top 10 customers contributed about 90% of the total revenue, and there are total 24 products that we would provide to them. With that being said, we will open the floor for Q&A. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, if you wish to ask a question, you may please press star and 1. The first question is from the line of Piyush Jain from NX Wealth Management. Please go ahead.
Hello. Hello.
Yes, sir. Please proceed.
Yeah. Sir, last quarter, we had the order book of around 5,500 crores. In current quarter, we are saying that we have signed some LOI worth around 4,000 crores. But in our slide number, page number 7, we are saying the outstanding order book and LOI is around 7,700 crores, something, 7,600. Can you just throw some light on this? Is there any difference? I'm missing something here.
So I think what you're missing is that the first order of Japanese was 1,400 crores, which has been counted differently, and that is a delta. If you adjust for that, it will be 7,700 crores. So it was signed before the results announced. So we had mentioned it in our announcement, and that's the reason. Otherwise, it was signed in Q1.
That has been so that has been counted in both time. In Q4 also it has been counted, in Q1 also it has been counted.
No, it has not been counted in Q4 and Q1 both. But in our results of Q4, when we are announcing, we said that after the quarter ending, in this quarter, this was one of the announcements that were there. And we have counted it in Q1 2024 because that is where the quarter would lie the announcement will lie on, right? So if you were to make it simple, 4,400 in this quarter, and before this quarter, the LOIs and contracts were signed were 7,669 minus 4,400, which will give you the number for the LOI signed as on closing of 31st March 2023.
Okay. And these all LOI and contracts are around 5 year to 7 year period, correct?
Correct. You're right.
What I trying to understand from last, if I say, let's say 2 years, from last 2 years around something, we are doing in the quarterly range of around 270 to 300. Last March quarter we did around 370. In June quarter we did 288. So what is the quarterly number? Let's say I'm not asking something in medium term. This is a long term, let's say 2025 or 26. What type of quarterly number we can think of? Let's say when all these contracts will start for ramping up and the delivery schedule start, because I believe this will take around 18 to 24 months time.
Okay, so let me clarify 2 points. One, that it will be difficult for me to give a number because that's something which is not a good practice of giving exact numbers of growth. But as historically what we have been mentioning, we will continue our growth journey as what we have been doing in the historical, in the range of 25% plus or minus what the numbers that we have been focusing for a long-term basis. And we'll continue that CAGR growth, 25% plus as we go. Coming to the LOIs and contracts, yes, these LOIs and contracts have started giving us revenue. Not that it will take another 2 years to start giving revenue. We have a contribution of over 100 crores in the FY23, and we expect these numbers to ramp up, and that numbers will ramp up to fully. If you just do one simple arithmetic of 7,700 crores, if I divide it by 5, I am talking about 1,700 crores of peak revenue. Now, would that be peak? Because many will ramp up fully in 3 years' time, and few will ramp up in 4 years' time. So if you look at it, eventually it will be that kind of a contribution, but it will be gradually that you will see that growth.
Okay. So can I say if what you are saying is 7,000 crore in 5 to 7 years, which gives you 1,000 crore annual basis, can we say this 1,000 crore would be additional as compared to 1,000 crore would be additional over and above 1,000 crore type of business we are doing now?
You're right. So whatever we have done now, there is 100 crores of revenue contributed from the LOIs, and if you take the last year's financials, yes, you are right, and then whatever are the new ones, it will be added to that. So you are right. Your statement seems correct on this.
Okay. So one question is on the gross margin, which I'm tracking companies in the last 2 years. Somewhere we were making a gross margin of 65% also, and over a period of time, this gross margin is reducing. I know on EBITDA front, we are more or less maintaining around 28 to 30%, 29% something. Is this something permanent change happened to the gross margin because of the nature of molecule or research, R&D or something? Or this is a temporary headwinds will again go back to a gross margin of 60% and above?
So I will do it in 2 manners. One is that this gross margin. See, typically we run our business on an EBITDA numbers rather than on the gross margin.
I know you said earlier also.
I'll explain that also. So see, this gross margin will be a combination. It will be reflection of the product portfolio for the quarter, because there'll be some products where the complexity of the molecules is less, and hence the overhead will be lesser, and hence you will see a different kind of RM contribution. Whereas if there is a long chain of product or a complex molecule, then the overheads will be higher, and that will have a different gross margin profile. Now, another thing that you will also have to see is is that Concall versus standalone. Because in standalone, you will have a Concall, you will have a 10-pack, and that will also have a different gross margin profile compared to the standalone, and that also you may want to decipher there. But again, I will say one thing. I would prefer to analyze our company more on the EBITDA level basis rather than a gross margin, for the same reason as we had mentioned in the past as well.
Okay. So last question on 10.
Good.
Okay, got it, sir. Last question on 10-stack. We have bought 26%, correct? And we are consolidating 10-stack number in our number?
Yes, we are consolidating line by line. Yeah, you're right.
Okay. What I'm trying to say, because 26%, sometimes people don't consolidate. So in 26% stake, you are consolidating. So my question is there any future thought to acquire maybe a 51% and above in 10-stack or something? Because I think some state government, Tamil Nadu or somebody is holding a 26%. So any thought on future, because 10-stack will be your HF and KF raw material supplier, correct? For your chlorination. So any future thought to acquire more stake in 10-stack, more than 51% and above?
So let me answer this question. So first is, the reason for consolidation is basically because we have the management control, and that's the reason our auditors have been convinced to do the consolidation basis. Coming to the intent or interest of we looking at an additional stake, yes, we would be happy to explore that, as we had also mentioned in our earlier calls as well, that we have a right of first refusal under the joint venture agreement, and if and when the TIDCO decides to offer their stake, we would definitely be using it for acquiring those shares that are offered to us as well, or the stake that has been offered to us. And as you rightly said, yes, the HF and KF will be used for our chlorination strategy, and the supplies have now started, and we would continue to ramp up those sourcing of raw material from 10-stack as we expand our portfolio in chlorination.
Okay, last thing from my side, sir. What is your view on CDMO from China and Europe? How is the flow and inquiries are coming to Anupam? Because what we have seen last 6 months or maybe a year, we have signed multi-billion dollars and multi-years contracts with these Japanese and US companies. So what is your overall view, how you see industry from right now at inflection point, how this can be a growth? It is a long-term decadal growth, or it's a 2-3 year phenomena, something?
Anupam, would you want to take, or shall I take a stab and you may want to add to it?
Yeah. Why I'm asking this also, because I don't remember. Our customer base is also around 50-60 type of customers. I don't remember exact number. But let's say around 53 products and 27-28 customers. So do we see there is a lot of scope for Anupam to increase their customer base or something? Because still currently also our top 10 customer contribution is around some 80% or 90% something number. So I'm talking about 5 years, 7 years. What is the growth pathway? Hello?
Yeah. So let me take this first one. So if you look at it, our total customers are 73 customers, of which 29 are multinationals. That is what we are saying, and we have 55 products that we have commercialized till now. So that's one part of it. Second, if you look at it from a geography perspective, around 60% of our revenue comes from an export, and balance comes from India, or little less than 40% comes from India. Now, coming to the geography and the kind of demand that we are seeing, as you could see from the LOIs and the contracts that we have been signing, the demand looks quite buoyant and robust. As we had mentioned in the earlier part as well, that the preference of the innovators to outsource manufacturing on a more custom synthesis basis to India is increasing compared to the other preferred geography that was there in the past, and that is a very secular trend that we are seeing, and more clear preferences that are coming on a relative basis. And so to that extent, we feel that India as a chemical manufacturing hub, especially the specialty chemical manufacturing hub, and more specifically to Anupam, we see that we have been a beneficiary of that, and we feel that this would continue. Yes, Europe will continue to be a significant player, and they would continue to have projects on the CSM and CDMO business. But India would be a net beneficiary of the whole game, and that's what we are seeing in our numbers that we have been signing. The order book that we have signed is also a reflection of the same.
Thank you, sir. Thank you. All the best for future. Thank you.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Rohan Gupta from Nuvama. Please go ahead.
Yeah, it's a good evening and thanks for the opportunity. Anand sir, many congratulations on continuous winning on the new contracts and signing new LOIs. It's very encouraging to see that the current quarter you have signed almost 4,000 crore kind of LOIs. That's a really remarkable job, sir. So first of all, congratulations on that. Sir, second question is on our current quarter performance. So what we understand that globally agrochemical environment is weak and many companies are delaying the orders probably, and because of the liquidation of inventory across the market. We are actually, sir, in a more of the contractual businesses and where more revenues are flowing from the agrochemical side of now. So what kind of risk do you see that in the current year we may have because of the industry where it is going through such a sharp environment, such a weak environment of inventory liquidation? That is one question. I'll come back in a second.
Hello?
Yes, sir. Can you hear me? Sir, could you hear me, sir?
Yeah, I could hear you. Okay. So I'll try and answer this. And so see, what we have been seeing is, you are right that there has been an inventory liquidation, and the channel supply chain is getting lighter as we go from a heavier to lighter part of the process. But coming back to Anupam, and what we have been seeing, as you rightly said, that because of the contractual nature of the business and the kind of revenue visibility, what is happening is that our demand continues to be robust. However, the delivery schedules have been pushed to especially the incremental growth demand has been pushed to the quarter 3 and 4 of the year, so which is the second half of the year. So you will see that the first 2 quarters will be more flattish in nature, and the second 2 quarters will compensate for the balanced growth of the year. And that's what we are seeing for now. The kind of indication that we have got from the customers and from the demand side as well is reflective of the statement that I made.
So, sir, in this kind of pushing back to the second half, do we see that there can be impact on margins because we also need to carry raw material as well as finished goods on behalf of customers? So that's the kind of business model which we were following. So do you see that in the first half we may see some inventory write-downs, related losses, or pressure on margins?
I don't think that's something which I would agree to. I would suggest that if you see, let's look at our last 3 years that people could easily see, and we had both the kind of a cycle. So one inflationary cycle that we saw a couple of years back, and up to the last half or a year up to last year, and then we have been seeing a deflationary trend that is coming back. And if you see in both the sides, we have been able to maintain the EBITDA margin. And that's primarily because of the kind of a pricing structure and the model that we have developed, where we are passing on all the costs, including the cost of raw materials, overheads, utility and energy. And that's the reason, if you see, we would not have an impact of any inventory pricing, repricing, or pricing or repricing and therefore translating into any kind of a losses there. So if you see, our EBITDA margins will be fairly in a consistent band of around about 26 to 28%, maybe a little higher probably in a quarter or two, but on an average you will see that kind of a number. And that's primarily because of the transparent cost plus model that we have on this.
Okay. And so the LOIs which we have signed before Q1, there was roughly 3,600 crore worth kind of contract which we have signed in last 2 years, which are supposed to, the contract which we signed in Q1 FY22, they were supposed to commission from the current quarters onwards, probably given the 2 years timeline. So there in these orders as well, we will see, we are expecting to see the delays. That is number one. And second, with the price declining across the commodity, so the roughly 3,600 crore worth of contract which was there signed earlier at those prices, are they going to lose the value in terms of because of the falling raw material prices, and will they be 10% or 20%, 30% lower than what they used to be earlier, resulting to lower revenues per year?
Okay, let me answer the first question first, and then I think the second half of the question. The first of the question is about the scheduling. I think from the schedule side, I don't think it has dramatically changed from the last few quarters that we have been projecting. I think the last year we did a revenue from LOIs and contracts to be around more than over 100 crores, and this year we should be doing additional 200 crores roughly. So it basically will ramp up to around 300 crores of revenue there. So that's what I would say for now. So total, if you look at it, that's the kind of a schedule. So I don't see schedule really changing dramatically from here on. For a molecule, maybe a quarter plus or minus can always happen, but on an aggregate basis, we don't see that dramatically moving away anything significantly different to what we had been planned, what we planned, or what we had also indicated in the past. Second is on the RM side. Yes, you are right that RM prices moving can impact the aggregate top line number. But if you look at from a RM to my revenue number, RM is around 40% of my total revenue, and especially in the newer age molecules, the RM will be even lesser compared to the older molecules. And so the impact, would it be significant, is a question that we can answer, and this is also multi-year contract, right? So today it may be in the deflationary environment, and hence we may say that there is a movement of a price here, but there will also be a more normalization of the prices, and hence I think over the life cycle, it's anybody's guess that where we end up. But today, when we go with an going in assumption, we would typically go by the assumption at which we have signed the target numbers and target cost and prices, and we would go by that. But you are right. During the period, there can be a deflationary and inflationary reflection of those numbers in it. I hope, Rohan, I could answer your question.
Yes, sir. Sir, if I may speak another question, and so especially this is your bit related to.
Mr. Gupta, may we request that you return to the question queue? There are participants waiting for their turn.
Yes, sure.
I think let's go with this one for now, and then we can keep that discipline. But let's as that we started, let him go with this question, please.
Sure, sir.
Please
after this I will come back into. So, sir, third question was in this latest contract which you signed with Sister Innoventure, that is the subsidiary of local company in pharma molecule. So just wanted to understand more. So far now we were getting the contracts mainly from the MNCs, and also is there we see there opportunity in a local players also, and increasing supplies to the domestic markets also. Is there something trend emerging?
So I would say here, if you look at it, 3xper is not going to be my customer. He is my joint venture partner. Mr. Govindraj is the gentleman who has been the focal point in this whole of this joint venture, who used to be CEO of Arvindo Pharma as well. Right. Now, the question that you're asking, that so in pharma, if you look at it, there are two-pronged strategies that we have here. One is that we will be looking at products which are right now not manufactured in India and imported in a reasonable quantity and high value. So that's one that probably we would look at, where we have a strong niche, and also we will have a strong advantage because the key starting raw material would be the same as we are in the agro value chain or in the polymer value chain, and fluoro will be one of the key flow play there as well. However, also we will be looking at exporting these products to the world as we have been doing it, and it will be little early. So it will be little early to say that what will the eventual mix. Would it be the same that is there right now, which is around 60-65% is export and 35-40% domestic. It is little too early to give you a view on that, but it's not that it is going to be a single pronged strategy. It will be both export oriented as well as import substitution. And again, in the same breath, I would like to also add that the business model that we would have on this will be the similar business model as we had for our other parts of the business, including agro as well as polymers and other parts of the business.
Sure, sir. That's helpful. Thank you very much, and I'll come back in.
Thank you. Thank you, Rohan.
Thank you. The next question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. So continuing with the pharma strategy that you just outlined, would it be fair to say that the products which are getting, let's say, launched here will be produced in Anupam's facility, and the client relation here will also be managed by Anupam, or it is managed to the JV entity?
No. So the business will be primarily run from Anupam with the support and collaboration with Mr. Govindraj and them. But yeah, it will be basically it's Anupam really in the game here, and we would leverage our technical capabilities, and they have their reach to the market, which will be also used by us to really work that out. But yeah, the sales will be directly to the entity, not using the JV as a vehicle to do that. Sure. That's the plan.
Yeah. And the two pharma molecules that we have launched in this quarter out of 10 that we plan, are these molecules in a way related to this JV or through this entity?
No. These are all in-house, which we have been working on for a long time, and that's now coming into play.
And these molecules will be a part of the fluorinated products that we were talking of earlier. Will that be a fair assumption?
Absolutely, Ankur. They are fluorinated products, and that forms part of our fluorinated portfolio.
Great. From a growth perspective, when do you expect this JV, the 3X per Innoventure JV, to start contributing? Because where I'm coming from is, while there will be separate pharma molecules that you will be launching independently, there will be some which will be launched through this JV, or the business which will come through this JV. When do we expect ramp up here? That is one. And whether we need a dedicated facility for the pharma products that we are making, or it can be made in the existing ones.
Okay. So Ankur, let me just first clarify that this is an MOU and not a JV. So we are not forming a corporate entity with them. What we are doing is we are sharing our knowledge and collaborating together and bringing our resources and experience together to monetize this this opportunity that we are seeing. Our strength on the chemistry side and on the process optimization, including flow and continuous process, is going to be leveraged here. So that's where. And in terms of timeline, I think it will take a fair bit of a time. So right now, the numbers that we have not yet crystallized the numbers to share with you right now. But right now, it's more in the development stage, and hence I would refrain from giving number guidance, Ankur, as you can appreciate for some time. And as we get more and more crystallizing the numbers, we would share with you. I hope that's
sure.
Appropriate.
Yeah, that's perfectly fine. And just on the pharma bit, the products, the molecules that we are launching, will they require a separate dedicated capex there, or it's already a part of the aggregate plan that we have?
This is whatever we are saying for now. It's part of the capex that has been incurred. So we don't need to have any further new capex for that.
Sure. The revenue guidance that we had talked earlier of around 25% plus, that includes the fluorination products also that we are launching. Any change in thought there, given that there is an RM deflation and probably that will be passed through to the customer? So any thoughts there?
So Ankur, as I was saying that I think the guidance that we would be going with this, and especially with the pushing a couple of quarters of demand from the first half to the second half, I think we should be looking at 20-25% of growth rate. More sharper number probably I can give you by the end of the second quarter. But as of now, from where the vantage we have, I think 20-25% growth rate, even 20+% growth rate is what we can talk about today for the year. And forward numbers I think remain intact, but this is where I would guide for now, and wait for a more quarter to give you a more sharper numbers on the year end.
Sure, sir. And just lastly on the LOIs that we have signed. Now, there are LOIs which we have signed since for quarter one of FY22. But if I got the earlier comments right, you mentioned FY23 has only 100 crore worth revenue from these LOIs. When do we see a bigger ramp up here? Is there any timeline that one should look at?
So this year, I think the total number should be around 300. So 200 addition going to 300, and next year should be a jump which is equal to this year's contribution.
Okay, and the revenue growth guidance that you give, 25%, is including these LOIs coming in, or it's top up?
Ankur, it will be too much to ask for without that, right, Ankur?
I thought I'd just double check with you still if you have any change in thought.
I would love if that was the situation, right, Ankur?
Sure, sir.
I think you should be part of our team on this. It will be very, very, very encouraging.
Sure, sir. That's helpful. I'll get back into the queue if I have more questions. Thanks. Thank you and all the best.
Thank you, Ankur.
Thank you. The next question is from the line of Drashti Shah from Blue Lotus Capital Advisors LLP. Please go ahead.
Hello.
Hi, Drashti.
Hi, thank you. I wanted to understand how much LOI of the last 5 years.
Drishti, we could not hear you. Can you please repeat the question?
Hello. Am I audible?
Yeah, please. Yeah, right now you're audible. Please go ahead.
Yeah. I wanted to understand how much LOI or contracts we must have signed in the last 5 years.
Drishti, that number right now I don't have on my hand. I can answer that offline.
All right, sure. And also, in case of Stanfac, how much percentage of the Stanfac's revenue might be captively used by Anupam?
As of now, it is not a very significant number, around 8 to 10% of theirs. But and going forward, that number would expand further. But I don't think we will be the major 50% or more than that of them, because what will happen that existing customers will continue to be supplied from this, and also as they are expanding their capacity, so we will partake from that capacity as well. But today it will be around 8 to 10%, not more than that.
Okay, so overall it might go up to 10-20% eventually when the fluorination part of the Anupam's revenue segment starts growing.
Correct, because their capacity are also doubling. So they've also announced the capex of 100 crores to double their HR capacity. So both we have to look at to see where we end up on that, right?
All right.
On an absolute number, the quantum will increase, but on a percentage basis, how much it would be, it's just a matter of some time that we can do the math.
Okay, sure. Thank you so much.
Thank you.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of S. Ramesh from Nirmal Bang Equities. Please go ahead.
Good evening, Anand Bhai and Vishal Bhai. Thank you very much. So if you look at the mapping of the addition to revenue from your LOIs and contracts here over the next few years, because they are long-term contracts, I have a number of around close to 600 crores in FY25 and another 1,400 crores in FY26. This is based on the details you have given in the presentation and the conversation I've had with you. So if you're looking at 200 crores addition in FY24 and 25, what is the kind of run rate you would expect, say, by 26 when a lot of the new LOIs will possibly start working in full? Would it be, in that 500, 600 range, or can it cross 1,000 crores? Because the reason why I'm asking is, if you're looking at the entire bunching of the orders, at some point, it should be in that range of 1,400 crores. This is the number I have. So I just wanted to give a sense in terms of where we are headed in terms of the visible addition to your top line from the all the LOIs being executed in full, whenever that happens.
So you're right that over a period of time, yes, we will get to that kind of a number. But if I were to look at for next 3 years, I think we can hit the hit a 4-digit number, or we should be shy of hitting the 4-digit number in next 3 years' time, including this year, if I were to count for. So that's the kind of a number. And otherwise, what math you have done is fair. I think we should be in that range.
Okay. And so in terms of the announcements you have made, there are some which are linked to your current capex and expansion of both chemistry as well as capacity. In some LOIs, you are saying you can use the existing facilities. So if you were to look at the overall scheme of things on a blended basis, if you're looking at the top line growth, isn't there a case that eventually with the operating leverage and the higher asset turn, your margin should go up beyond 30%? So if you can give us a sense in terms of on the incremental revenue from all these LOIs put together, what would be the full potential asset turn once your entire capex is completed by, say, 25, 26, and then incrementally to continue to execute these orders, what will be the ongoing capex, say, between 25 and 30?
So Ramesh, I will do a bit of an effort, a bit of an estimation and all. So please take those numbers in that zest as well. But if you look at the total capital deployment that we have done till date and what we were budgeted for or planned for, including the 670 crores of capex that we have announced last year, I think the revenue potential on that should be from the current product mix and the plan that we have. I think we should be in the shy of around about 3,000 crores of revenue capability. Okay, will we reach on that same year? I'm not saying that. But I'm saying the revenue capacity will be that much from the plant side. So that's the first question that I'm answering. Two, if you look at it from a revenue growth perspective, as we had said that the revenue growth will be in the range of the historical numbers that we have been highlighting. So that's the second point. The third question that you were asking in terms of what is the additional capex that you would need. So see, what we are saying is the incremental asset turn, if you look at it, will be between 1.75 to 2. Let's take it even at 1.75. So even if I want 400 to 500 crores of revenue growth or annum at that scale to continue the growth momentum, probably you're looking at around about 250 to 300 crores, 200 to 300 crores of capex on an annual basis.
Okay, fair enough.
Now this is, Ramesh, please take it with a bit of a caution here because it's a ballpark number that we are just hypothesizing rather than guiding.
I understood. So if we go back to the discussion on the JV with the TI Group company, so if you are going to give the chemistry and also managing the clients and the relationships, if you can explain to us what is the value that the TI Group is adding, because the press release gave the impression that you are going to build a CDMO business for the TI Group company, and the TI Group company is also developing a CDMO business. So now that you are saying it's an MOU, what is the value brought by the TI Group? Because they have also talked about getting into CDMO and making some serious investments, and they also mentioned that Mr. Gondra is heading that. So eventually, if that is something which is going to be material, if we can get some more clarity in terms of how that will be, institutionalized in terms of the framework, and what is the value that you expect the TI Group company to add and Mr. Govindarajan to add on this.
So let's talk about what values they add and what values we add. Okay. So first is they add is that their market. Mr. Govindarajan has a fantastic insight and access to the pharma market, especially the Indian and the international one. So that's something that will be there. Their ability to pick the right molecule and its tree or a chain, that will be helpful to us. Not that we are not doing it today. We are doing it today, but that only enhances our understanding better. One. Two, what are our strengths? Manufacturing capabilities, process optimization, process knowledge, continuous process, high-end, those kind of process strength that we have. That is what we will be bringing into the picture, right? Now, so that's the value addition between both of us. Now the question is, what will be the exact numbers and when it is? Give us a little bit more time to frame that before we come to you and give you a guidance or a more formal view on this, because it's right now an MOU, and that will be converted into a more formal relationship as well as we go forward. So right now the work is more on the R&D lab and on the pilot plants rather than on the manufacturing plant. So let's just wait for some time before we really give you any more concrete numbers or plan on that.
Okay. Just one last thought in terms of your balance sheet and how you see the debt and working capital moving in the next 2 to 3 years based on the ramp up in the business from the new orders. That would be helpful.
So see, as we were saying that our asset turns will continue to improve. If you really look at it, our asset turns have continued to improve, and that is also reflective of our ROC, which has gone to 15% in the last year itself, and we look at improving that as we go further. So yes, the asset turns will continue to improve. As we have more and more brownfield expansion, the asset turns will be even better as we go. So that's the second point. Third, as we had also mentioned in our past calls as well, and as we anticipate, the working capital intensity of the business will drop as we go because of two primary reasons. One, as you rightly said, that a scale will help in that, and two is also the cautionary inventory which was there, or cautionary working capital that was there in the end of FY22 is unwinding. So both should continue to have a downward trajectory, and the numbers that we are saying is what we have been historically also mentioning, which would be dropping it from 290 to 250 and then going down to 220 to 200 and sub 200 as we go further on the net working capital side over the next few years.
And what about the debt? What is the kind of debt you expect to end with in our FY24-25?
So I think debt, if you look at it, is a simple function of two parameters, and hence I don't want to pin a number on that. One is the capital that we would want to deploy going further. Today we have our plan, so we are not adding any more debt, any more capex, and we are not loading any debt onto this. And the cash flow generation will naturally unwind the debt to that extent. So right now, I think that's what we would like to leave it at probably, and I would not want to give any more guidance on that. The only thing I'm saying is that there are no new capex as of now. So if you look at from a current thing, 670, we don't need any further debts to achieve those capex.
Okay, thank you very much. Wish you all the best.
Thank you, Ramesh. Thank you very much.
Thank you. The next question is from the line of Rohit Nagraj from Centrum Broking. Please go ahead.
Yeah, sir, thanks for the opportunity. So first question, again, harping on the agrochemicals environment. So we have seen commentary from global players as well as domestic players that from the innovator side also, they are facing the challenge in terms of the inventory destocking. So was there any impact in Q1 for us in this regard? And based on our conversations with the customers, are there any postponement of orders that we have seen for the next maybe couple of quarters or so? Thank you.
So Rohit, see, as I was saying, that typically the demand buoyancy that we saw is what we have been mentioning also. But what you rightly said is that let's say for the year, we are looking at a number which is what we mentioned, around 20+% growth rate on an aggregate basis. But yes, the first 2 quarters are looking like flattish in terms of growth. It will be a flattish number. So to that extent, if you want to say postponement or if you want to say shifting of the incremental demand to the second half, answer is yes.
Right, got that. Second question is in terms of the margins. So just wanted to clarify, you also mentioned earlier that we pass on all the raw material or any OPEX increases to our customers. So that is the business model which is there in our legacy business and it is continuing with the newer LOIs as well, or is it the new LOIs where we have taken this particular provision?
No, this is across majority of our product portfolio, legacy as well as a future one.
Right, got it. And just one last clarification. When we say that we hold inventories of say 250 days to 25 days, do we physically hold the stock in our in our premises, or how does the arrangement works with the maybe the vendor from which we are buying those raw materials?
No. So see, vendors historically do not give us a forward contract or a forward volume. So we cannot book a volume and say that I will offtake this over the next 12 months, because they will say today's price is today's price, tomorrow's price is tomorrow's price, and hence we need to have the inventory bought out, and that's the inventory that we have bought out, and we hold it in our warehouses and in our plants. So and it will be all three in terms of raw material, work in progress, and finished good, all three, because all the three are parameters that our customers would look for, because they will also be insisting on a particular level of finished good inventory as well. Because as we had mentioned earlier also, that there are significant number of places, products where we would be primary or a single supplier to them, and hence they would want to have that supply assurances and supply surety, and that's where the finished good inventory also will be equally important to them, over and above the raw material inventory.
Right. Got it. And just one last question, if I can squeeze in. From the newer LOIs perspective, what is the ROC hurdle rate that we work on?
You know what kind of ROCs that we should be looking at, right? And I can assure you that we will be doing better than that for sure. I would not want to put a number to that right now and make it into a public domain. But you can imagine the kind of ROCs that we would be chasing for, and I can assure you that it will be better than that.
Perfect. Thanks a lot for answering all the questions.
I hope, apologies if I have not been so clear on that, but I hope that you appreciate, right?
No, the implied answer is good enough. Thank you so much, and best of luck.
Thank you. Okay.
Thank you. The next question is from the line of Priyank Chheda from Valium Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. So my question is, if you can share the revenue recognition of the schedule for the LOIs that you have received in the current quarter, maybe a ballpark number for FY25-26 and beyond. What would be the revenue recognition that you would do?
So there'll be some bit of a revenue that we would see even in this year as well. But large part of the revenue would come from calendar year 25 and beyond.
Okay, so would it be fair to assume that
for the LOI signed in Q1 FY24, I'm saying, right?
Sorry, sir, I couldn't get it. Can you repeat?
I'm saying for the LOI signed in Q1 FY24, that the statement will hold true, which I said just a minute back.
Got it. Okay. And in general, for the total LOIs that we have been receiving till now, around 7,700 crores that we have received FY22 till date, what kind of capex requirement would be there to execute these LOIs?
So, as I would say that, these are part of my revenue projections in the future as well, right? And so it's part of the total business plan that I have, and as I mentioned, around 670 crores of the capex has been undertaken, is underway, and that should give me additional revenue for around 12 to 1300, total to 3,000 crores. So if you look at it, large part of my LOIs and contracts would be serviced from this capex itself. Maybe something which will be in 28 or 29. Probably there may be a bit of it for which I may need to do additional capex, but the LOIs and contracts we will be able to start servicing them, and as they ramp up, the capacity expansion may be required for those kind of products. As you can appreciate that we have a multi-purpose plant, and hence our ability to work with these products and its sizing is always very, very fungible to that extent.
Got it. So the capacity that we have and the additional capex of 670 crores plan can execute a revenue, I can execute the LOIs that we have received till date. Is it fair understanding?
Yeah, if you were to just do a simple arithmetic, yes, today if you look at it, last year I was at 1298, and if I were to add 1500 or 1700, then if you put the simple arithmetic, it comes to the number that is there. But you have to also be mindful that there will be products which I will be launching it from other products also, which are not right now not even envisaged in the LOIs and contracts. So to that extent, there will be mix. That's what I'm trying to say. Okay? Got it.
Just a last bookkeeping question, if you can share, what's the inventory on the books as on Q1 FY24 end?
I would refrain from making that because we don't announce it on the quarter, so I would not say. But the trajectory is the kind of trajectory that we have been highlighting. But I would refrain from making the balance sheet numbers discussion for now.
All right. No problem. If I can squeeze in one more question. We have announced a dedicated fluorination capex of around, I think, 400 in the neighborhood of 400 crores. Now, which also includes, which would be executed within the LOIs. The strategic question that I want to understand is what's the kind of a unique technology that we have, and if you can share what's the right to win within that fluorination chemistry, or is it that the MNCs from whom we are executing these LOIs, have they shared the technology, or is the in-house R&D team that has worked on? If you can help with that. Thank you.
Okay, so I will talk about, let me answer the last question first, and then I'll answer the right to win question as well. The answer is that we don't take tech packs from a customer, and most of our products and technology is in-house, and thanks to our R&D team that they have been able to deliver these kind of products. So that's one point. And if you look at from a right to win, if you look at it, will come from coming from the credibility that you created over so many years, and delivering it day in and out, because you are in a B2B kind of a business where assurance in the price, volume, quality, timelines, schedules is so much important that that's something which we have been able to do. And with the production strategy that we have done, which is a multi-purpose plant, has helped us because we can ramp up, ramp down as per the customer requirements over the quarters and the years. So that's one right to win. Two is the right to win is from the technical capability that we have generated over so many years, because it's not only fluorination that you need, right? If you want to develop a product, then you have multiple chemistries that you will require. Fluorination is one strong one that comes in, but then there may be nitration, hydrolysis, or multiple chemistries that is there. So the larger the repertoire of portfolio of your chemistry strengths helps you strengthen and buttress your position in the market with the customers. So that's the second part of it. Third is from the supply chain point of view. We are basically a part of supply chain for any innovator and multinational, and hence the larger, the stronger, and the deeper the supply chain it is, better it is for you. So if you're starting from HF and KF and able to deliver to that's something which is strong that is there. So you start from KSM and you end up at N-2, N-1. That's what they would love you for, right? So that's the third right to win. Fourth is process optimization and our ability to drive the cost curve because of the expertise, experience, and the know-how that we have generated over a period, be it from solid recovery or from distillation or from other processes, moving from batch to continuous to flow chemistry. That's something which comes in. I think in the opening remarks of Anand Bhai as well, he had mentioned that we've also commercialized one of the fluorinated products in flow, which is probably the first time in the world, and we would be able to launch it in some time. So these are the right to wins that we really see. And the most important is Are you the most reliable supplier for the customer and ability to grow with them? If the answer is yes, that's the right to win. And these are the 4-5 things which will come into play. There will be more, but I'm just highlighting the 3-4 key that comes to my mind upfront.
Thanks a lot.
I hope I've answered your question.
Thanks a lot.
Great, thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for the closing comments.
Thank you everyone for joining this call. We hope we have been able to answer all or most of your questions. If you have any further questions, please feel free to reach out to our IR agency, EY, and we will get back to you offline. And thank you very much. Have a good day.
Thank you, members of the management team. Ladies and gentlemen, on behalf of Anupam Rasayan, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.